Disclaimer.
Today is January 14th, 2026, and the world has just officially passed the point of no return. Have you seen these numbers? Silver just broke $91 and gold is storming $4,630. But the real story is not in the numbers on the screen. The real story is in your comments under my previous video. While Citibank is urgently updating its forecast for gold to $5,000 by March, you are writing to me that there is just no physical metal. One of my subscribers signed that his order from Comex for $78 has still not been shipped. Why? Because in the UK, the physical price is already $120 per ounce. This is the same great break that we warned about. Today, we will analyze why banks are massively increasing forecasts right now when the system is bursting at the seams. What to do with your paper ETFs while dealers freeze supplies. And most importantly, will the system survive until March, or will we see the Comex collapse in the coming days? Hold on to your bars. We're getting started. You check your screen this morning and see silver trading at $92 per ounce. That's remarkable enough, considering it was under $30 just 2 years ago. But here's what should grab your attention. If you actually try to buy a physical silver American Eagle coin right now, you're not paying $92. You're paying anywhere from $100 to $120. That's a 30% premium over the official spot price, and across major dealers in our country, that gap is widening by the hour. What if I told you that the price you see flashing across financial networks is not the price you'll actually pay when you want to hold silver in your hand? We're witnessing something that hasn't happened in modern precious metals markets. The paper price and the physical price have completely separated, and that separation is triggering delivery halts across the United States that most Americans don't even know about yet. Last Friday, multiple major U.S. precious metals dealers stopped accepting orders for junk silver and scrap silver purchases entirely, not because they don't want your business, but because they physically cannot source the metal to fulfill orders at anywhere near the prices they're quoting. According to data from major bullion platforms, inventory levels for standard silver products dropped to zero across the board within 72 hours. We're not talking about some boutique items or collector coins. We're talking about basic 1-ounce rounds, 10-ounce bars, and the American silver eagles that millions of Americans rely on for precious metals exposure. Think about what that means for a moment. You're watching silver climb to generational highs on your investment app, maybe thinking about taking a position or adding to your stack. But when you go to convert that paper price into actual metal you can store in your safe, you discover the real market is operating in a completely different reality. The gap between what the system says silver costs and what you actually pay to possess it has never been this wide in the modern era, and it's revealing a structural problem that goes far beyond simple supply and demand. Here's where it gets interesting. On January 14th, the United States Mint made an unprecedented announcement. They suspended all silver American Eagle sales, citing extreme price volatility as the reason. This is the same institution that continued producing and selling coins through every crisis we faced, from the 2008 financial collapse to the pandemic panic of 2020. But now, with silver at $92 per ounce on paper, they've pulled the plug entirely. The U.S. Mint has never taken this step in modern history, and they're not doing it because the price is too high. They're doing it because the underlying mechanism that's supposed to connect paper prices to physical metal has broken down. Let me put this in perspective with something that happens behind the scenes in the precious metals industry. When refineries need to process silver, they don't pay cash up front for all the metal they're working with. They lease it from banks and large holders, paying a lease rate that's typically somewhere around 2% annually. It's a financing mechanism that keeps the physical metal flowing through the system efficiently. This lease rate stayed stable for years, even during major price moves, because there was always enough silver available to lease. But according to industry sources, those lease rates exploded from 2% to over 100% in just a matter of days this month. Think about what a 100% lease rate means for a refinery. If they need to lease $1 million worth of silver to process for just 1 month, they're now paying almost $100,000 just to borrow that metal for 30 days. That's not a functioning market. That's a market in seizure, where the cost of accessing physical metal has become so extreme that the entire financing system refineries depend on has frozen. These aren't small operations we're talking about. These are the facilities that transform raw silver from mines and recycled material into the coins and bars that Americans want to buy. When their financing costs spike to 100% annually, they can't afford to operate, and the flow of new physical product into the market stops cold. Now, here's the piece that ties this all together and explains why our dollars can't access silver, even though the price looks reasonable on screens. On January 1st, China implemented export restrictions affecting approximately 120 million ounces of annual silver production. China isn't just another player in the silver market. They're the world's largest producer and a critical source of refined silver that flows into Western markets. According to trade data, China produces roughly 150 million ounces of silver annually, and about 80% of that used to be available for export in various forms. Those restrictions just cut off nearly a third of the world's tradable silver supply in a single policy change. The impact showed up immediately in Shanghai. Premiums in the Chinese domestic silver market spiked to 12 to 13% over Western paper prices within days of the restrictions taking effect. That tells you something crucial about what's really happening. Chinese buyers, who now have restricted access to export their silver, are willing to pay 12 to 13% more than the so-called global spot price just to secure physical metal within their own borders. They're not looking at screens showing $92 and thinking that's the real price. They know the real price is whatever it takes to actually get the metal delivered. Pop quiz: if you're an American investor or someone looking to preserve wealth in physical silver, and you can see that Chinese buyers are paying 13% premiums, while US dealers are charging 20 to 30% premiums, what does that tell you about the paper price you're seeing? It tells you that $92 is a fiction. It's a number that exists in the futures market and on trading screens, but it has almost nothing to do with the price required to move actual silver from a refinery to your doorstep. This isn't a temporary spike in demand that will smooth out when speculators lose interest. The structural changes are global and systemic. China's export restrictions aren't going away next month. Lease rates don't drop from 100% back to 2% overnight when the fundamental shortage driving them remains in place. And here's what most analysts aren't telling you. The U.S. Mint's suspension of Silver Eagle sales is not just about price volatility. It's about their inability to source silver blanks from refineries at any price that makes sense, because those refineries can't afford to lease the metal they need to produce those blanks. You might be thinking this sounds like a crisis, and in some ways it is, but it's a very specific kind of crisis that reveals something important about our financial system. For decades, we've had paper markets in precious metals that allowed institutions to trade massive quantities of silver that didn't physically exist. Futures contracts, exchange-traded funds, certificates, and allocated accounts all created the illusion of abundant silver available at stable prices. As long as most people were content to own paper claims on silver rather than the actual metal, that system worked fine. Banks could sell the same ounce of silver to multiple buyers through different paper instruments, and as long as those buyers didn't all demand physical delivery at once, nobody noticed the discrepancy. But something shifted in the past few weeks that is forcing the paper and physical markets to confront each other. When lease rates hit 100%, it's because there's literally not enough physical silver sitting in vaults available to lease to all the refineries, ETFs, and institutions that need it. When the US Mint stops producing coins, it's because they can't secure blanks without paying prices that would require them to sell eagles at $130 or more. When dealers halt junk silver purchases, it's because they know they can't flip that material for a profit when their own costs to acquire replacement inventory have gone parabolic. Have you noticed how different this feels from a normal price spike in a commodity? When oil prices jump, you pay more at the pump, but you can still fill your tank. When housing prices rise, mortgages get more expensive, but you can still buy a house if you can afford the payment. But with silver right now, you're discovering that the advertised price and your ability to actually transact at that price have become completely disconnected. You're being quoted $92 while being charged $120. And the reason isn't greed or manipulation by your local dealer. It's because $92 is what silver costs in a computer system, while $120 is what it costs in the real world, where you need a refinery to lease metal process, ship it, and take the risk of holding inventory in a market this volatile. According to industry insiders, several major dealers stopped buying scrap silver and junk silver bags last Friday specifically, because they couldn't find buyers willing to accept that material at prices below $100 per ounce. Think about that dynamic. In a normal market, dealers love buying junk silver at a discount because they can sell it quickly or send it to refiners. But when refiners can't afford to lease the silver, they need to process that scrap. And when retail buyers are already paying $120 for new coins, suddenly there's no profitable spread for the dealer. They're stuck in the middle of a market that's breaking down at the structural level. This is what a genuine physical shortage looks like in our modern financial system. It doesn't announce itself with empty store shelves or government rationing programs. It announces itself with premiums that make no mathematical sense, with mints suspending production, with lease rates that would bankrupt anyone trying to use them, and with dealers who simply stop answering their phones when you ask about delivery times. The paper market keeps functioning because paper is infinite. You can create another futures contract with a few keystrokes. But the physical market is exposing the limits of a system that assumed infinite paper could substitute for finite metal indefinitely. Here's what should concern every American watching these developments. If the paper price and physical price can separate by 30% in silver, what does that tell you about the reliability of any price you see on a screen? Your retirement account shows certain values for your stocks and bonds. Your home has an appraised value. Your savings account has a number attached to it. But we're learning with silver that sometimes the number and the reality are just two different things. And you only discover which one matters when you try to convert the number into something you can actually hold or use. The mechanism breaking down isn't just about silver. It's about the gap between what our financial system claims exists and what actually exists in the physical world, where supply and demand play out with real constraints. So, your local dealer is telling you there's no silver available. But what are the biggest banks and institutions in the world saying about precious metals right now? This is where the story gets really interesting. The very same week that physical silver becomes nearly impossible to source, Goldman Sachs releases survey results showing that 36% of institutional investors predict gold will trade above $5,000 per ounce by the end of 2026. These aren't retail investors watching YouTube videos. These are the people managing trillions of dollars in pensions, endowments, and sovereign wealth funds. They were looking at the same broken system we are and drawing the obvious conclusion. If paper markets can't deliver physical metal at quoted prices, those prices are going to have to catch up to reality. Citibank didn't wait until year end to make their move. According to their updated forecast released just days ago, they're now calling for gold to reach $3,800 to $4,000 in the near term. Think about what that means. Citi isn't some fringe analyst trying to generate clicks. They're one of the largest financial institutions in the country, with access to the same interbank data and vault inventories that show exactly how tight physical metals markets have become. When they raise their forecast by that much, that quickly, they're not guessing. They're responding to data that shows the current pricing structure simply cannot hold. Here's what makes this moment different from previous precious metals rallies. Central banks have been buying gold for 18 consecutive months, with China leading the charge according to World Gold Council data. But this is not the kind of buying that happens when countries are just diversifying reserves slowly over time. This is urgent, persistent accumulation that suggests central banks know something about the stability of the current system that they were not broadcasting to the public. When China buys gold month after month without pause, they aren't worried about missing a few percentage points of return. They're worried about counterparty risk in the dollar-based system that dominates global trade. Now let's connect those institutional gold predictions directly to what's happening in physical silver markets, because they aren't separate stories. They're two parts of the same underlying crisis. While banks are forecasting $5,000 gold, the Comex registered silver inventory has collapsed. Registered inventory is the silver that's actually available for delivery against futures contracts. And according to exchange data, that inventory is now at levels that cannot support the open interest in the futures market without significant defaults or cash settlements. We're not talking about a modest drawdown. We are talking about inventory levels that represent less than 2 weeks of global consumption at current demand rates. But here's the detail that confirms we're in unprecedented territory. Silver is trading in backwardation. That is a technical term that means the spot price of silver is higher than the futures price. In normal commodity markets, futures prices are higher because there's a cost to store and finance the commodity over time. When that relationship flips, it signals that physical metal is so scarce right now that people will pay more for immediate delivery than they will for delivery months from now. The last time silver showed this level of backwardation was in 1980, during the Hunt Brothers silver corner that briefly sent prices to $50 per ounce. Today's backwardation is even more extreme, with spreads reaching $3 or more between spot and nearby futures. The signals couldn't be clearer. Thanks for watching, and be sure to follow for more updates. Think about what that $3 spread really means for anyone holding a paper position. If you own a silver futures contract for delivery in March, you're watching the spot market trade $3 higher than your contract price. That spread isn't supposed to exist. It exists because the physical market is screaming that metal available today is worth significantly more than promises of metal available in 90 days. And if you're a refinery that needs to lease silver to process orders, you're facing that same problem. Why would you pay 100% annual lease rates to borrow silver for processing when the forward curve tells you that silver will be worth less, not more, in 3 months? You wouldn't, which is exactly why refineries are shutting down processing capacity and the flow of new supply into retail channels has stopped. Have you noticed how this creates a self-reinforcing spiral? Refineries can't afford to lease metal, so they stop producing coins and bars. Without new supply hitting the market, premiums on existing inventory keep rising. As premiums rise, more retail investors try to buy before prices get even worse. That increased demand hits a market where dealers have no inventory and no way to source new inventory at reasonable costs. So dealers either raise premiums even higher or halt sales entirely, which creates more urgency among buyers who can still find metal, which drives premiums higher still. This isn't speculation about what might happen. This is the cycle we're watching play out in real time across our country right now. London vault depletion adds another critical piece to this puzzle. London is the global center for precious metals trading, with vaults holding billions of dollars worth of gold and silver that back exchange-traded funds and institutional positions. According to industry sources, those vaults have been experiencing significant outflows as investors who previously held paper claims on metal decide they want physical possession instead. When you withdraw metal from London vaults, it has to be transported typically by secure carriers that charge around $2.50 per ounce for transatlantic shipment. That's always been a manageable cost that kept London and New York prices roughly in line with each other. But now there's a new problem that's turning that simple transport cost into a liquidity crisis. Tariff uncertainty between the UK and the United States has created a situation where dealers don't know if they'll face 25% or even 50% tariffs on precious metals imports. Those aren't confirmed numbers. They're rumored, which is almost worse, because rumor means dealers can't price the risk accurately. So instead of paying $2.50 per ounce to ship silver from London and dealing with an unknown tariff on arrival, many U.S. dealers are simply refusing to source from London entirely right now. They're waiting for clarity that may not come for weeks or months, and in the meantime, the flow of metal that used to balance regional price differences has stopped. Pop quiz. If you're a dealer and you can't source from London because of tariff uncertainty, you can't source from China because of export restrictions, and you can't source from domestic refineries because they can't afford lease rates, where exactly are you supposed to find silver to sell? The answer is you can't, which is why multiple major U.S. dealers halted junk silver and scrap purchases entirely since last Friday. They're not buying because they have nowhere to sell what they buy. The entire chain of supply that kept physical silver flowing from mines to refineries to dealers to customers has multiple broken links, and each broken link makes the others worse. This is where our understanding of the gold forecasts becomes crucial. When Goldman Sachs surveys show that 36% of institutions expect $5,000 gold, they're not just making bullish calls on a commodity. They're acknowledging that the paper system that kept gold prices suppressed through futures markets and unallocated accounts is losing credibility. Every time another silver investor tries to take physical delivery and discovers they can't, or they can but only at massive premiums, it reinforces the lesson that paper claims are not the same as physical possession. And if that lesson applies to silver, it applies to gold too, because both metals trade in the same basic structure of paper markets that oversell physical supply. According to the Bank for International Settlements, the notional value of gold derivatives outstanding globally is measured in hundreds of billions of dollars. Those are paper contracts that reference gold, but don't require physical settlement. As long as most participants are content to settle in cash or roll contracts forward, that system works fine. But the moment significant numbers of contract holders demand physical metal, the system doesn't have enough gold to deliver. We're seeing this dynamic play out in silver right now because silver is a smaller market where the pressure shows up faster. But make no mistake, the same mathematics apply to gold, and institutions managing billions of dollars know this. Here's what should concern every American with retirement savings or investment portfolios. If Citi is right and gold reaches $4,000 while silver is in this kind of physical shortage, what happens to the exchange-traded funds that millions of Americans own through their 401ks and IRAs? Most precious metals ETFs claim to be backed by physical metal in vaults. But when you read the fine print, many of them allow for cash settlement under certain circumstances, or they hold unallocated positions that don't give them specific bars with serial numbers. In a true physical shortage, those distinctions matter enormously. You might own shares of a silver ETF that's trading at $92 per share, only to discover during a crisis that the fund can't actually source enough physical silver to meet redemptions and is going to settle your position in cash at the paper price, while physical metal is trading 30% higher. London is already showing signs of this stress. Multiple reports indicate that delivery times for physical gold and silver in London have stretched to 2 to 3 weeks for transactions that used to settle in 2 days. That might not sound dramatic, but in precious metals markets, 3-week settlement is effectively admitting that the metal isn't sitting in the vault ready to deliver. It means the vault or dealer has to source it from somewhere else, which takes time in a market where sourcing has become extremely difficult. And if London, the most liquid precious metals market in the world, can't deliver in 2 days anymore, what does that tell you about the state of global physical supply? Japan provides another data point that confirms the global nature of this shortage. According to Japanese market data, premiums on secondary market silver reached 60% above international spot prices in recent weeks. 60%. Japanese investors trying to buy silver aren't paying $92 per ounce. They're paying nearly $150 per ounce because that's what it costs to actually acquire physical metal in a country that imports virtually all of its silver. When you see premiums that extreme in a developed economy with functioning financial markets, you're not looking at temporary supply chain disruptions. You're looking at a fundamental mismatch between the amount of paper silver that's been sold and the amount of physical silver that actually exists. Think about what all these pieces together reveal about the true state of precious metals markets. Institutional forecasts for $5,000 gold, central banks buying for 18 consecutive months, Comex registered inventory collapse, $3 backwardation in silver futures, 100% lease rates, London vault depletion, UK-US tariff uncertainty, dealer purchasing halts, Japanese premiums at 60%. Each of these facts on its own is significant. Together, they paint a picture of a market structure that's being stress-tested to failure in real time. The paper prices on your screen haven't caught up yet because paper is still trading based on the old assumption that physical supply is abundant and delivery is reliable. But every day that passes with premiums at 20 to 30%, with mints suspending production, with dealers unable to source inventory, that assumption becomes less tenable. This is why the institutional money is moving now. They're not waiting for confirmation that the system broke. They're positioning before the break becomes undeniable to everyone. When 36% of surveyed institutions predict $5,000 gold by year-end, they're essentially saying they believe the paper price will have to rise dramatically to reflect the reality that physical metal is much scarcer than the current pricing suggests. And when Citi updates their near-term forecast to $4,000, they're telling their clients that this repricing could happen in the next few months, not years. Your paper ETF might show gains on your statement, but if you can't redeem those shares for physical metal at anything close to the paper price, how much is that position really worth? That's the question American investors are starting to ask. It's the question that could trigger the next phase of this crisis. Because once enough people lose confidence in paper claims and demand physical settlement, the system simply doesn't have the inventory to satisfy everyone. Something has to give, and history suggests that when paper and physical prices diverge this dramatically, it's the paper price that eventually adjusts upward, often violently, to meet physical reality. Now let's talk about the mathematics that make this situation inevitable. According to the Silver Institute, global silver markets are running annual deficits between 95 and 117 million ounces. Every single year, humanity consumes more silver than we mine. But here's the critical detail most analysts miss. 70% of silver is mined as a byproduct of copper, lead, zinc, and gold mining. When silver prices double, mining companies can't just open more silver mines because most silver comes as a secondary product from mines extracting other metals. Those mines make decisions based on copper or gold prices, not silver. The supply response is minimal even when silver goes from $30 to $92. Now layer China's export restrictions on top of that structural deficit. 120 million ounces of annual Chinese production just vanished from tradable supply on January 1st. We're talking about 20% of global supply either deficit-driven or suddenly restricted, before accounting for any increase in investment demand. Here's what that mathematics means. The physical market is already forcing $100 to $120 transactions right now. Your screen shows 92, but actual purchases cost 120. That gap closes one of two ways. Either physical premiums collapse because supply becomes abundant, or paper spot rises to meet physical reality. Given supply is tightening with Chinese restrictions, refinery shutdowns, and mint suspensions, which direction do you think convergence happens? According to dealer reports and futures positioning data, we're likely to see $100 spot silver by February. That's not prediction, that's recognition that current $92 spot plus 30% premium equals $120 people already pay. Once spot breaks 100, it confirms the paper price can no longer hold back physical reality. By June, when Federal Reserve rate cuts materialize with 2 cuts already priced into forward markets according to CME FedWatch data, silver should trade between $130 and $150 per ounce. But here's where this gets serious for the financial system. Paper silver trades with leverage ratios estimated at 300 to 1. For every physical ounce in vaults, there are 300 claims through futures, ETFs, certificates, and unallocated accounts. When physical premiums hit 30% and delivery times stretch to 3 weeks in London, these are signs the 300 to 1 leverage is starting to matter. The system doesn't have 300 ounces for every 300 claims. It has 1 ounce, and those 300 people will fight over who gets real metal versus who gets cash at the understated paper price. According to market rumors, institutional cash settlements have already begun. Multiple sources suggest large futures holders have been approached about settling in cash rather than taking physical delivery. When those rumors become confirmed facts, when institutions openly acknowledge they're settling contracts in cash because they can't deliver metal, that's when paper silver's leverage breaks completely. Every remaining contract holder will immediately demand physical delivery because cash settlement means getting paid at the artificial paper price, while physical trades much higher. Have you thought about what happens to ETF holders in that scenario? If your fund's silver is held in unallocated form in London vaults, showing 3-week delivery delays, what exactly do you own when leverage breaks? You own a promise for dollar value at paper price. But if physical trades 30 to 40% above that price, your ETF shares will dramatically underperform physical metal. This is counterparty risk. Your investment depends not just on silver's price, but on your counterparty's ability to deliver physical metal at that price. So what's the target sequence? February brings $100 spot. Silver as paper catches up to physical reality, triggered specifically by delayed release of 2026 Silver Eagles. When Americans discover they can't buy the most popular silver coin even after waiting months, demand shifts to whatever inventory exists, pushing premiums higher and forcing spot prices up. By June, with Fed rate cuts, silver reaches $130 to $150. Lower rates weaken the dollar and make precious metals more attractive, creating technical momentum on top of the fundamental shortage. Physical premiums, currently running 20 to 30%, will only collapse under two circumstances. Either paper contracts face widespread defaults, where institutions openly settle in cash because they can't deliver metal, causing paper price to spike dramatically to meet physical reality. Or China reopens export channels and floods the market with 120 million ounces they've restricted, which seems unlikely before 2027 given the strategic nature of their decision. In the more probable scenario where China doesn't reopen and paper contracts start defaulting through cash settlement, we could see spot prices exceed current physical prices by second half 2026. If physical silver trades at $120 today with spot at $92, that's 30% to close. But if spot overshoots because paper leverage breaks and 300 claims compete for every ounce, spot could reach $150 to $200 as the system reprices for reality that most paper claims will never be honored with physical delivery. Think about your positioning. If you're holding physical silver at $120 today, you're ahead of a repricing that could see spot double within 12 months. If you're holding paper silver in ETFs, you're exposed to counterparty risk that could see your investment underperform physical metal by 30 to 50% if the fund can't source silver. If you're holding no precious metals exposure, you're watching your dollar savings lose purchasing power to real assets with genuine scarcity repricing away from paper currencies. Here's what you can do with this information. If you own paper silver ETFs where you can't take physical possession, understand you're exposed to counterparty risk. If you're planning to buy physical silver, recognize current $120 prices aren't overpriced relative to where spot will likely trade within months. If you're already holding physical purchased at $20 or $30 years ago, you're sitting on generational returns with metal new buyers literally cannot source. What we're witnessing isn't traditional commodity shortage where high prices bring new supply. We're witnessing repricing of the difference between paper claims and physical reality in a market where 70% of supply comes as byproduct that can't respond to price signals, where annual deficits run 100 million ounces, where China removed 120 million ounces from tradable supply, and where 300 to 1 leverage has been hiding that most paper claims will never be honored with physical delivery. The $120 price you see today for physical American Eagles is on a premium that will disappear. It's early price discovery of a market transitioning from paper-based to physical-based pricing. The $92 spot is the old system maintaining illusion that abundant supply exists. The $120 physical price is the new system announcing that abundance was always an illusion created by leverage, and now that illusion is breaking. By February, spot confirms what physical markets know by breaking $100. By June, with Fed cuts and accelerating investment demand, spot reaches $130 to $150. By year-end 2026, if the math around leverage breakdown plays out, we could see spot above $200 as paper fully reprices to reflect physical scarcity hidden for years by 300 to 1 leverage nobody questioned until they tried to take delivery. This is the great break we warned about. Your subscriber who ordered from APMEX at $78 and still hasn't received metal while physical hits $120 is living through the early stages. The question isn't whether this transition happens. It's already happening right now across every precious metals market globally. The question is whether you position ahead of the repricing or behind it, whether you understand the difference between paper claims and physical possession before that difference costs you 30 to 50% of your wealth. Hold onto your bars, because the system promising you silver at paper prices is about to discover promises aren't the same as metal. When 300 people with promises compete for 1 physical ounce, it's the people already holding that ounce who win. The mathematics don't lie. The supply constraints are real, the leverage is breaking, and the repricing has already begun.